But before we do that, I want to start with the plain vanilla version. And the plain vanilla version is we are all greedy capitalist pigs out there to maximize shareholder wealth because that's what we are told to do by our corporate charters. So how do we do that? Well, the answer you already know. We do that by looking at a sequence of cash flows and analyzing its net present value, converting all of those cash flows into a common currency, adding up all of the various different currencies, and then calculating what the net is. And if the net is positive, take the project. If it's negative, don't take the project. If you've got lots of different projects and you can take them all, take the ones that are positive, don't take the ones that are negative. And if they're mutually exclusive, take the one that is the largest positive project and get rid of the rest. So that's it. That's in a nutshell what capital budgeting is about. Now that sounds pretty straightforward, but applying it requires some practice. And you're going to get examples of that over the course of the next few weeks. So here's one example that I think is pretty trivial, but I want to go through it anyway, again, just to make sure that we're all on the same page. Suppose we develop a flu vaccine, and there are two different approaches to that. One approach is we can bring it to market within a year. Now, it's going to cost $1 billion right now in order to do that. But once we do it, it's going to yield $500 million, $400 million, and $300 million in profits in years 1, 2, and 3. So that's one strategy. The second strategy is we bring it to market in 2 years, investing in two different tranches. We invest $200 million now and $200 million next year, and then we get returns of $300 million in years 2 and 3. Which one of these should we do, if any of them? And not surprisingly, if we calculate the net present value using the appropriate cost of capital and drawing a timeline so that we know exactly what the sequence of cash flows is, once we do that, the answer is pretty clear. For A, the net present value is $98 million. For B, the net present value is $141 million. Take B, okay? And if you can do both, take them both, because they're both positive NPV. But in this case, it was set up as either A or B, so we're going to do B. The main challenge in dealing with these kinds of problems is not how you calculate the net present value. That's actually the easiest part. The hardest part by far is figuring out the cash flows, because that relies on projections, and we don't have crystal balls typically. We have to make guesses, and the guesses are often wrong. Now, I'm not going to talk about that until the very end of class today, so I'm going to just assume that we do have a crystal ball and we can see the various different cash flows. But even so, there's some work that we have to do in dealing with accounting, because in large corporations in particular, when you're looking at projects, very often the data that you get is data in the form of accounting figures. And the problem is that accounting figures don't always correspond to what we think of as market-related variables. And in a minute, I'll tell you why it is that we care about these market variables. But for now, what I want to do is to talk a bit about how accounting data needs to be translated into net cash flow information. And there's just a couple of concepts that you need to be aware of. Obviously, most of you, if not all of you, have taken an accounting course, so you know that there are lots of subtleties in how you account for various kinds of cash flows. For the purposes of financial analysis, we need to focus on net cash flows as opposed to earnings or other kinds of accounting variables. So in order to do that, I have to talk to you about bathtubs. I don't know if your 401 a lecturer described it in this fashion, but this is how I was taught about accounting data. And it has to do with this wonderful looking bath right here. Now, there are two elements of this bathtub that you need to know about. One is the water that's flowing into the bathtub, and the second is the level of the water in the bathtub. Those are the two different concepts that we need to understand for accounting. And those two concepts correspond to stocks and flows. A stock is not to be confused with the stock market. A stock just means the amount of something. So the stock of water, the total volume of water in the tub at a point in time, is one measure of how that tub is looking. But the second measure is the rate at which the tub is being filled, the rate at which the water is coming into that tub. And it turns out that when we try to measure the performance of a company, we want to use both stock and flow measures. We want to know at a point in time, what's a company worth? How much value is in the company tub. And the second thing we want to know is how fast is that value growing or shrinking? Stocks and flows. So if you remember the bathtub, you will know everything you need to know, almost, about accounting as it relates to what we're going to do. The stock variables that we typically deal with are part of the corporate balance sheets. The balance sheet measures the amount of stuff, whether it's assets or liabilities. It is the level of assets or liabilities at a point in time, right? It's the stock of those quantities. On the other hand, flow variables are basically money going into and out of the company. You can think about it as the income statement, but actually this is sort of like a budget constraint for the firm. You know, the uses of funds in any given year, the rate of change of funds has to add up to the sources of funds. So the amount of money that goes out better equal the amount of money that comes in. That's an accounting identity. It always adds up. But from an economic perspective, it also makes sense. You can't spend more than you have, and whatever you have, you're going to have to divide it up into the various different expenditures. So using those two relationships, we can back out what we need in order to estimate the value of a project. Okay? So this is the formula that you learned in introductory finance. I won't belabor the point other than to mention that it's net cash flows after taxes, because we always got to pay taxes unless you're tax exempt. You got to pay taxes. So it's your net cash flows, net of taxes, that we want to focus on for the purpose of valuing a particular project. So when you decide whether or not to take on a drug development project or device, you have to understand what its net cash flows are. And that's different from the accounting earnings.